Welcome back, Sean. Cup of
Thank you,
coffee?
Lee. Thanks.
Yes. Grab anytime you want your coffee. Drink away.
I'll have a sip now.
So last time we met, we spoke about the financials. We went through it from a very high to the different parts of the annual financial statements, et cetera, et cetera. We didn't really delve deep into it. But I think one of the topics that, that appear in our annual financial statements that we didn't delve into was depreciation. Depreciation of assets. And I think let's have a little bit of a conversation around that one.
Sure. Let's talk about it.
So I'll admit that, over the years, being in as a small business, or when I started my business, I actually didn't get my head really wrapped around the depreciation on assets. As a small business, it was just very simple. I bought the asset and expense it. That's it. As I grew into understanding my own business and business-related things and really getting into it, I actually found out depreciation is a very important part of my business, and more so understanding my business. If I understood it better, I could use the depreciation, and this is the key point, to my advantage within my business. For example, very quickly again, how I can use depreciation as part of reducing my profit margins.
Yes, but it's not necessary. It's not the depreciation. The depreciation terminology is used in accounting. For tax purposes, they call it wear and tear. And there's different articles inside the Tax Act utilizing depreciation on the asset, but within the Tax Act, it's wear and tear. So you'll have normal straight paragraph. I think it's 19. I think normal assets, and then you got manufacturing assets and wear and tear on buildings, and it's either a manufacturing building or an office retail kind of building. So there's different factors that measure that on the tax side. But depreciation as such is a tool to say that the useful life of my asset, my fixed asset, is 5 years, for instance.
Okay.
And over the 5-year period, I will equally depreciate this asset so that I can see where I'm at to provide for replacing it.
Yes. Yeah.
What the value will be in 5 years' time of my business as such, because the fixed assets can be a core portion of your value in your 100%, business.
100%, correct. So before we delve a little bit further into it, that's valuable points that you made. Let's just remind ourselves not ourselves, because I'm sure you know and I know, but our viewers, insofar as when we talk about an asset in a business, what type of assets are we talking about?
There's two types of assets that gets classified in a set of financial statements. You've got fixed assets, or PPE as they call it, property, plant and equipment. It's usually long-term assets that you'll be using for more than a 12-month period.
Okay. Or they're fixed.
You can't move them.
Yes. Yeah.
And then you get current assets. And your current assets is usually inventory, debtors, your bank account, and short-term loans, stuff that will be put into cash within a 12-month period.
Yeah, that's what you said,
or shorter.
If I remember correctly. So just to clarify for myself, is that the current assets, as the name says, it is current, it is now, and as you said, within 12 months we can move it into cash in some form or another. Where a fixed asset, what was the term? PPE?
PPE, property, plant and equipment.
Which is generally something that you can't really
That'll
move.
Be your motor vehicles,
yes,
your office equipment, computers, computer software.
100%.
So
yeah, so that's it. So at least we understand. And if we go back to our financials, it's really depicted like that in the financials. In the balance sheet.
Correct.
Clearly in the balance sheet, it had assets.
Your fixed assets will be on top.
That's correct.
100%. Current assets below that.
100%. So let's just go back to the depreciation and the reason why I wouldn't say why we depreciate the asset, or the tax man allows you to depreciate the asset. So I'm going to explain it in my simple terms, and maybe you can just fill in the blank. So, and again, I go back to my original statement, which I said that in the past, I always thought about, well, you bought an asset, just stick it in it, it's expensed, ends the story. That's how we think. We go and buy a screwdriver, we buy that is expensed. However, and obviously, and let's use a screwdriver as so what the tax man, what I understand is the tax man allows you to purchase something in the use of your business. In other words, the screwdriver. That screwdriver that you purchased puts you in a position to earn more money for him. The tax will not earn money for the company, which in turn allows him to tax you for that specific thing. So he says to you, okay, because you purchased the tool, you can take that tool expense off the income that you earn. Was that correct in saying that? Right.
Correct, yeah.
So now, but obviously, we can't go and buy a piece of equipment. Well, not obviously. A screwdriver is only like, whatever, $100.
Yeah, there will be differences on
it's 100 Rand. But now if I go and buy a tool that is worth R1 million, and you can't go and write that thing off in 1 year. Well, you could potentially, depending on what category it sits in. But generally, you're going to use that R1 million tool over a pretty long period within your business, over 2, 3, 4 years, depending on how you're going to use that specific tool. So the tax man says to you, I'm not going to give you the right to write that tool off in 1 year. I'm going to allow you, because you're going to earn income over 5 years, over the life of that tool, and I'm going to allow you to depreciate it over so many years. So you can't write it off.
In theory, that's exactly what the act or the Income Tax Act allows you to do, and what the financial, the accounting policies allow you to do as well. Yeah. Sometimes they are in line with the Revenue Act. They give you 5 years on a motor vehicle, and you say, well, I'll depreciate my vehicle in 5 years. That's not necessarily realistic, because a vehicle can last 20 years.
Yes.
But for business purposes, you have a certain mindset that says, well, I'm going to use this vehicle in the plumbing industry.
Yes.
We're on the road every day, probably 12 hours a day.
Yeah.
And we're going to do 100,000 kilometers a year. By 5 years, 500,000 kilometers, it's most probably not going to be worth anything or last much longer.
Yes. Or you can't use it to generate further income out of it, because it's because it's breaking down, or whatever it looks like.
Yeah. So it can be an owner's decision on how long he wants to depreciate his vehicle. Yeah. SARS will not say, well, if you say 3 years, I'm going to give you 3 years. Now they'll say, listen, the rules are 5 years. So if you do it quicker in your books for your own sanity, to say when you have to start replacing vehicles, and it's different from what we allow you to, well, that's your choice.
Yeah.
And there's accounting policies and practices to get around that, but that's a bit that gets technical.
Mm-hmm. So if I understand you correctly, is that and just again my layman's terms is that, like you said, the receiver says, if you buy a vehicle, again, and let's just go back to the principle. If you buy a vehicle, let's say it costs you 500,000 Rand a year. Sorry, 500,000 Rand. I bought that vehicle, right? And the rule is for that asset class with regards to the vehicle. And I remember you said that it was 5 years for a vehicle. Is that correct?
That's good.
So it's 5 years. So that means that the on a straight line depreciation, in other words, every year, the taxman will allow you to write off 100,000 Rand per year against your income or against your profits.
Against the profits.
Against the profits.
Yeah.
So if I've turned over R1 million and my profit is, say, 100,000, and I bring my depreciation in of 100,000, my profit will be zero.
Correct.
We can't bring in the full 400,000, which we expense the vehicle for that year, because then I'll be in a negative of 400,000.
Correct.
The next year, the receiver will allow me another 400,000. Correct?
100,000.
So on and so on.
Correct.
So after the second year, I might have reduced my vehicle's depreciation by 200,000, but the vehicle is still worth 300,000 in the books.
Correct.
But as you said, in the plumbing industry, we might be driving the vehicle so much that it's not worth for the business at that particular generating the income, and therefore we need to then sell the vehicle. Correct in saying that, because it's not worth it.
The value in the books for the business, the vehicle might be worth less than the receiver perceives it to be at the same point in time.
Yeah, correct.
You'll have a difference between what the wear and tear is that the receiver will allow and the depreciation that you see your vehicles being, going down in value.
Yeah,
because depreciation is a reduction in value.
Yes. Yeah. So, and then going back to your earlier statement, let's just keep on with this thing, is that when you look at a set of financials, because you said about the asset value in the company, that asset value will reflect that 300,000 that is remaining. Let's say after the second year is remaining, it means that that asset class in the business is still worth 300,000 from a book value, from a paper exercise.
Yes.
You might walk outside and find that the bucket doesn't look like 300,000, but that's what the asset. So again, that is why we go back to the point how important your financials are, because it gives a third party insight into your business, except instead of going to physically come and sit in your business and count up every single piece of asset, go and see what it's worth. At least it gives you a very good synopsis from that point of view. Correct in saying that?
No, that's 100%. That's why everybody trusts whomever is producing those financials on behalf of the client.
Yes,
100%. To know what they're doing, understand the principles behind the accounting, so that whatever is reflected makes a bit of sense and as value to it.
Yeah, and it goes back to the fact that, if you're trying to show somebody else obviously then doing it yourself, there's a little bit more, but getting an accountant in and helping you do that specific thing adds value to that set of books.
It is, because if you do not have an accounting background and you do not understand the principles of depreciating an asset, you'll buy it. You'll say, okay, well, I know I have to
I'm going to expense it.
Fix it.
That's all I'm going to do.
Oh, for some reason, somebody told you, no, you can't expense it. You have to put it on your balance sheet. You put it there. Now you've got a vehicle or a machine or something that you bought 10 years ago, but you have never depreciated it. Now you present this to someone and says, "Wow, there's my balance sheet," and they're like, "Wow, geez, you've got assets here of R1 million. When did you buy it?" No, 10 years ago.
Yeah.
Wow. Well, that guy's like, okay, 10 years ago, and it's still R1 million. It must be something big or something rather expensive. And when you go into the detail and say, well, you've never written this off yet. No, I don't know how to, or something like that. That's why the accountant is there to
help
out. To help it out and to put some trust into what you present.
Mm-hmm. So previously you mentioned the different classes, if that's the right word. So just go a little bit deeper into that. What do we mean by the different classes of assets? Assets as in depreciation of those specific assets.
Oh, different fixed assets.
Fixed assets.
Current assets won't be depreciated.
Yeah.
Well, you can. It depends on, but there's a lot of.
But don't worry about that. Let's stick to the fixed assets. Yeah.
Fixed assets. Look, you've got you'll classify your assets according to class. Motor vehicles, for instance. You will have heavy vehicles, cars that have trucking businesses. They'll have the heavy vehicles, they'll have the trailers, they'll have the vehicles that's the support vehicles. Then they'll have maybe a yard where they fix all the breakdowns. There'll be a factory or a workshop set up that'll fall under buildings. for instance.
And there's tools, I would make an assumption, to fix the vehicles.
Tools is difficult because tools can be screwdrivers and hammers and stuff, but those are all, how can I say, it's consumable tools.
Yeah.
And a screwdriver gets
Can
lost.
find legs very quickly.
So, and the loose term in accounting is loose tools. Loose tools.
Yes.
It's a
not
common phrase.
like a tool that is a fixed piece of equipment.
Yeah, it's not like not like a bench grinder or a drill press that gets mounted to the floor and it's there. It still can get legs, but it's more difficult, and it's there. It's going to last.
And so, why would the taxman put them into different classes? For what reason is that?
They've got different wear and tear
periods. One for a better word.
For a better word, yeah. So, and then obviously there's criteria towards it. Now, if you have a huge fresh produce packing line that sorts potatoes into sizes and washes them, and that thing will cost 15 to 20 million probably. And it's considered to be a manufacturing industry. Or SARS will say, okay, that specific machine, you can wear and tear it 50% in the first year, 30%, and then 20%.
So over a 3-year period.
But different. But on your books, it'll be like, okay, but this thing's going to last me 10 years. I'm just going to write it off 10% for the next 10 years.
Yeah.
And SARS will be, no, this is quite a big expense. No, let's help you out in the beginning. We'll give you a much bigger write-off.
Yeah.
So that you don't pay as much tax. You use that additional cash flow to put it into your
operating
infrastructure, basically. Yeah. So that's why there's categories.
So just to, again, for my mind, is that a building, for argument's sake, depreciates or doesn't get wear and tear as much as a vehicle.
Yeah.
And therefore, the taxman says, I'm only going to allow you to depreciate your building over a longer period versus a vehicle, which is over a shorter period, because I understand the wear and tear is so much higher in that specific.
No, correct. And obviously, but there's a lot of rules and stuff in place that you have to meet before SARS will allow you to start doing the wear and tear on, say, for a building or a manufacturing plant or just a normal computer.
Yeah. How long is a computer? What was it?
Usually
generally?
3 years.
3 years, because the technology changes so quickly.
Technology. Software is usually 2 years, based on
whatever.
Yeah. If you design, if it's specifically designed for you can probably say it's going to last longer. But most companies and organizations stick to what SARS gives you.
Yeah. So then if I understand it correctly, SARS tells you as accountants, it's in our rule book, and the different asset classes, and then it tells you, and they get adjusted periodically. They review it. I presume.
Review it, and it doesn't really necessarily get done every year, but they do review stuff and they bring stuff in, and a different class or. Years ago, you couldn't have any wear and tear on an office building, for instance. Okay. Now it's changed. New rules and stuff, but they do.
The principle applies. It's just the period that basically changed and a few adjustments.
But every year there's a lot of changes.
So Jacques, I just want to, as I was learning when I got into business and going through the process, and as I mentioned to you, I didn't really put too much emphasis on depreciation, understanding my assets, and also really delving deep into my financials. Just went by, like you said last time, I just turned to the last pages. How much tax do I owe?
Yeah,
that's it. And then over the years, I got into it, and then I realized I could use my assets and my depreciation to my business's advantage if you were clever enough, not to try and swindle anything, but if you were clever enough. And what I want to know is there anything that you can think of how best a business can use it to their advantage? And let me explain it from my perspective. So obviously you try and match your depreciation with the income. That's what SARS is trying to do. Is trying to help you out as a business. And you said it earlier on. SARS might come to you and say, you bought this potato machine, and we're going to help you out by depreciating first in the 50%, so you can take it off your profit, that 50% that you make. Isn't that so?
Correct.
But at the same token is that at some point in time, that asset is paid for, but it's generating an income. Isn't that so?
Correct.
So therefore, if it's generating an income and it's still working perfectly, a piece of equipment, no problem from that point of view, is that then you don't have any assets to depreciate, and therefore you're not going to reduce your profits. And that's what I always thought about, is saying, well, okay, I acknowledge that you've got this piece of asset and it's working fine, but put yourself into a position where you can acquire more assets, because you're creating more to get your depreciation in, to reduce your business. If that makes sense?
It makes sense. If you get into the mindset of putting money away for replacing an income producing asset, depreciation is a good way of telling yourself, what must I have in reserve for when this machine or this vehicle has reached the end of its line, the end of its lifespan. And you can have an idea of, well, if I've got a vehicle that cost me 500,000 year one when I bought it, I bought it cash, and I used a lot of resources, bought it cash, put it into the business. It's going to last 5 years, hopefully. By the end of year 5, I might get some scrap value out of it.
Yes.
So you can probably say, okay, well, it's 500. I'll get, say, 80,000 at the end for scrap. So 420 is going to be a depreciatable amount.
Yes.
So every year I know this 80 or 100,000 or whatever I depreciate needs to be in profit, so that I can put it away.
Yes.
Profit after tax.
Yeah, got it.
Because that's going to be what I'm going to be. I need to replace it.
Yeah.
So you can measure, if you really go into your financials and really have a look and see and say, well, I need to make enough profit so that there's money there for replacing this vehicle. Because if you want to replace it in cash, you need the cash.
Yeah,
cash needs to be somewhere.
Because you used the cash up front.
Yeah.
You took it out. You said right in the beginning, if I buy the 500,000, I had to have got it somewhere. And you said you bought it as cash.
Yeah.
So your business's asset has been dropped by 500,000, but is appreciated with this vehicle.
Yes.
By 500,000. But that vehicle depreciates. As it depreciates or goes down, you need to replace the asset value somewhere else, the cash, if you want to. So what you're saying is that if you depreciate it in the first, let's use that simple terminology, is that over 5 years you need to depreciate. That 100,000 Rand that you have depreciated it off your profits needs to not go and spend, now we made money.
Yeah.
It's not. You need to put it back into your kitty to
For
make
the
sure
replacement
for the
value.
replacement value at the end of the day.
Yes. Come replacement date, and you say, well, look, my business has now grown. I've got a nice, as I call it, the CV. I always refer to a set of financials as the business's CV. And I can use that and finance my vehicle.
Yes.
Then you say, well, okay, the money that I've now put away aside for the next cash buy, and I'm not going to use it. I'm going to use the bank's money.
Yep.
So now I can maybe pay a dividend to myself and go, spoil myself a bit.
But that's a different story.
But that's what depreciation and tracking it assists you in.
Yes,
to find out what you have to do going forward.
Hence, going back to our very important statement, your balance sheet and your set of financials are important to understand your business from a holistic point of view and how to use those assets from a depreciation, where you sit at this particular point in time, how much money have you got saved from that depreciation, which we spoke about that we took off. Have you put it in reserve? But you need to know where you are, and the game plan is your financials.
Yeah, correct.
Anyway, you touched on the loans and going to the bank and getting loans out of that one, I think I'd like to delve a little bit deeper into that next time.
Yeah, sure.
But thanks very much for joining me.
Thanks.
Appreciate it, and speak to you next
Thank
time.
you, Lee. Thank you.
Thank you.